welcome to the first of a new occasional series where myself and the Asset Intelligence team answer your questions about the markets directly. We'll get underway with our first batch in just a few seconds. First though, if you've got a burning question on your mind that you'd like us to answer in the next video, email us at the address you can find in the comments, or just let us know right there. So with that, let's dive straight in. Many of us overindulge at Christmas time and regret the effects in January, and this year it seems global stock markets are suffering a similar fate. After racking up strong double-digit returns in 2021, including rude health right through the month of December, the global stock market returned -4% in January. So it's been quite a post-Christmas hangover. What's behind this? Well, the main reason is inflation. Prices are now rising at a year-on-year rate of 5.4% in the UK and an incredible 7% in America, and we're seeing similar in many other countries too. Investors have turned their attention to what they expect central banks, like the Bank of England, will have to do this year to rein it in, namely raise interest rates. Now, at a basic level, rising rates pose a challenge for markets. People tend to spend less as their payments on mortgages and other loans increase. Businesses face reduced profit margins when they borrow to expand their operations. And the incentive to invest at all is reduced when you can get higher rates by just leaving cash in the bank. So investors expressed some concern in January as it became clear that the Federal Reserve, America's equivalent of the Bank of England, will move more quickly with rate rises than many had previously expected. One of the key pillars of our approach is to ensure that our funds and portfolio ranges contain broad and diversified exposure to a wide range of different asset classes, regions, industry sectors, and investment styles at all times. This helps to ensure that at least some holdings should be performing relatively well at any given time. As a result, our portfolios and our growth fund offers some exposure to strategies which focus on value and cyclical stocks. Now, in the decade or so following the financial crisis in 2008, global economic growth was pretty slow, so it made sense for investors to favour the shares of innovative and fast-growing companies like the big US technology names, which were clearly capable of generating their own growth, and these led the market. However, now things look different, with growth and inflation higher across the globe. Against that backdrop, the argument for companies whose returns are more dependent on the general state of the economy and so trade at cheaper prices begins to look much stronger. Away from shares, our lower risk defensive fund has also taken steps to manage this environment. It contains strategies with exposure to shorter dated bonds, which tend to perform better than their longer dated counterparts when rates rise. Yes, plenty. First, keep in mind that although stock markets tend to rise over time, it's normal for them to face setbacks and drawdowns at some point each year. This year it just so happens that things have gotten off to a difficult start. But that doesn't mean events have to continue in this same manner throughout. Meanwhile, the world is continuing to emerge from the pandemic and the economic recovery continues. Forecasts for corporate earnings growth remain positive. Households still have plenty of extra lockdown savings squirreled away. The global recovery in employment has been little short of remarkable. So the news is certainly far from all bad, and shares continue to look like the most attractive of the major asset classes to us. Well, that's our virtual postbag empty for this first outing. Thank you very much for listening, and as I mentioned earlier, get writing in.